Hey, what's up everyone? Welcome back to the channel. In today's episode, we're exploring the art and strategy behind put options, your secret weapon in trading. Whether you're shielding your portfolio or speculating on market downturns, mastering put options is essential. So let's get right into it. Put options are like your financial shield. They give you the right, not the obligation, to sell a certain amount of an asset at a preset price before the option expires. This is particularly handy for protecting your stock investments against dropping prices. Imagine you own a stock that's at risk of falling in value. A put option serves as your safety net, letting you sell your shares at a guaranteed price no matter how far the stock drops. These options aren't just for protection, they're also a playground for speculators. Buying a put means you could profit from the decline in an asset's price without ever owning it. It's a low-cost strategy for potentially high returns, providing a safety layer and a speculative opportunity all rolled up into one. Put options can act as your market parachute, offering a predetermined sell price, which is the strike price, which you can use no matter how much the market value of the asset falls. This feature is invaluable in unstable markets where prices can plummet unexpectedly. If you're holding put options, you've effectively set a floor on the potential financial hit you could take. Furthermore, put options open the door for speculative traders who bet on a stock or market's decline. This dual utility makes put options a crucial part of any savvy investor's toolkit, helping you navigate through bearish market waters with confidence. The price of put options is shaped by various factors, including the market price of the asset, the strike price, time until expiration, and the asset's volatility. Essentially, the more the market price of the asset drops below the strike price, the more valuable the put option becomes. This is because it allows the holder to sell at a higher price than the current market rate. Volatility is especially crucial. Higher volatility increases the chances of the option being profitable, thus raising its price. Time also plays an important role. The more time until expiration, the more valuable the option, as there's more chance for favorable price movements. Trading put options means strategically anticipating market movements. Whether you're hedging against potential losses or speculating for profit, it begins with picking the right strike price and expiration. The balance between the cost of the option and potential market movements is key. Conversely, writing put options, which is selling them, suits those expecting stable or rising asset prices. It's a way to earn from premiums while accepting the risk that you might have to buy the asset at the strike price if the market dips unexpectedly. Exercising the put option means choosing to sell the asset at the strike price, often a move made when the market price is significantly lower. This decision should balance the intrinsic value of exercising the option against the premium paid to acquire it. Sometimes, however, selling the option before it expires can be more profitable, especially if it still holds considerable time value. This requires a nuanced understanding of market dynamics and option valuation. And for those diving deeper into investing, I give real-time trade alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial link in the description below. With that out of the way, let's go over an example. Let's say you buy a put option for XYZ company at a strike price of $180 with the stock currently at $194. If the stock price drops below $180, your option gains value, allowing you to either sell the shares at a profit or sell the option itself for a higher price. This strategy caps your risk to the premium paid, contrasting sharply with the unlimited upside if the stock plummets. Writing put options is a bullish strategy where you earn the premium but risk having to buy the stock at the strike price if it falls below that level. It's a way to generate income or potentially buy stock at a net lower price if the option is exercised. This requires a precise understanding of market conditions and option valuation. Choosing between in the money, which is ITM, and out of the money, OTM put options depends on your investment strategy. In-the-money options cost more but offer immediate intrinsic value, suitable for those looking to hedge. Out-of-the-money options are cheaper, providing higher potential returns on a significant market downturn, but with greater risk of expiring worthless. And there you have it. Whether you're an experienced trader or a beginner, put options are a powerful tool in your trading arsenal. What strategies will you deploy? Share your thoughts below, and don't forget to hit that subscribe button for more insights into the investing world. Keep it real, and I'll see you on the next video.